This week, from March 1st to March 7th, gave equity markets two very different but equally important stories. On one side, Europe saw its worst week in almost a year, as investors reacted to rising geopolitical tensions, higher oil prices, and weakening economic sentiment. On the other side, in the United States, Marvel and Broadcom reinforced a very different message. The AI trade is no longer just about Nvidia. It's a much broader ecosystem involving custom chips, networking, and data infrastructure. Starting with Europe, the main headline was a sharp sell-off in regional equities. The Stoxx 600 fell 5.5% over the week, its biggest weekly decline in close to a year. Major markets like Frankfurt and Paris saw their sharpest weekly falls since April 2025, while Madrid posted its biggest weekly drop in 4 years. What is important here is that this is not driven by one or two disappointing companies. It was broad-based repricing of risk across the market. The main reason for the worsening macro backdrop, the ongoing Middle East conflict, kept geopolitical risk elevated and pushed oil prices to multi-month highs, which immediately raised concerns about both inflation and growth. This mattered especially for Europe because it remains more exposed to imported energy. As a result, investors began worrying about stagflationary environments, in other words, slower growth combined with higher inflation. Weak US labor market data added to these concerns by making the global growth outlook even less certain. In equities, this played out through a classic risk-off rotation. Investors moved away from sectors that are more sensitive to the economic cycle and looked to more relative defensiveness. European banks came under pressure, healthcare stocks also fell, while the energy sector was only Stoxx 600 sector to finish higher on the day. Defense names like Rheinmetall and Leonardo also gained as markets priced in the possibility of stronger weapons demand. So even with a broad sector sell-off, the performance still told a very important story about investors and what they feared most. Another key feature of the European market was the rise in volatility. Europe's volatility index spiked to its highest level since April, earlier in the week, and remained elevated into Friday. That matters because higher volatility does not just reflect nervous sentiment, it also affects positioning, hedging costs, and overall willingness to take risk. Now, in contrast to Europe's macro-driven weakness, the US AI story was much more about strong company-level guidance. Marvel forecast fiscal 2028 revenue approaching $15 billion and said fiscal 2027 growth revenue would exceed 30%. Broadcom, meanwhile, projected AI chip revenue above $100 billion by 2027. It also reported first quarter revenue growth of 29% to $19.31 billion, with AI revenue more than doubling to $8.4 billion. What made these announcements especially important was that they suggested about the next phase of the AI trade. For much of the last year, investment saw AI largely through the lens of Nvidia. But Marvel and Broadcom strengthened the view that AI spending is benefiting a much wider range of companies. Both firms are deeply involved in custom chips and data center connectivity, helping hyperscalers design infrastructure tailored to specific AI workloads. Broadcom also with major customers such as Google and OpenAI on customer processor development. The key driver here is CapEx. Alphabet, Microsoft, Amazon, and Meta are expected to spend at least $630 billion this year on AI infrastructure. The spending does not only support demand for top-end chips, it also drives demand for networking, interconnect solutions, servers, and custom silicon. So the AI trade is increasingly being viewed not as a narrow single stock story, but as a much broader infrastructure build-out. The main takeaway from this week is that markets were sending two messages at once. In Europe, the message was that equity sentiment remains fragile when geopolitical shocks threaten both growth and inflation. In the US, the message was that investors still have a strong appetite for companies with real earnings, exposure to AI, infrastructure, and spending. For equity investors, the contrast is important because it shows that market analysis has to go beyond headline index moves and look more closely at sector rotation, volatility, guidance, and where leadership is beginning to broaden.